Good morning, everyone. Today is Wednesday, January 4th, second day of the 2023 trading year. And so, what happened yesterday? Did you make money yesterday? Did you trade yesterday? Today, we'll start out looking at the news just to get a reference on what we can expect today. So here's the news. It's about an hour before the market is due to open. Flags are generally in the green. And the news is, well, what do we want to know in looking at the news? What we want to know is, where's the market going today? And so, you're not going to find it in looking at the news. Interesting reading, entertaining perhaps, but you're not going to find it. The news today is more telling in the economic calendar. And looking at the economic calendar, well, we see that there is an FOMC announcement due at 2 p.m. For those of you who are not familiar with the FOMC, or Federal Open Market Committee meeting, it's where the Fed announces changes to interest rates and also gives some kind of clues as to what their thinking is longer term. So when this happens, and just at the time, or just before the time of the announcement, it's probably a better idea to be sitting on the sidelines because it tends to get very volatile just before and immediately after the FOMC announcement. Well, this is the price action from yesterday. This is the 1-minute chart of the S&P E-mini. And the market opened up right over here. I want to call your attention right to this time spot right over here. This is at 9:30, just at the market open. And this line that I've drawn on the chart, well, that's the close of the previous closing session. That's the close on Friday. And the market gapped up. Now, most of you who are trading for a while know that the gap trade is a trade that presents an opportunity that is often profitable. Now, the gap trade is when the prices open significantly above or below where they closed the previous session. Now, I'm not talking the overnight session. I'm talking about the regular session from 9:30 a.m. to 4 p.m. So, right over here at 3860 is where the E-minis closed at 4 p.m. on January 30th, the previous trading session. But the market opened right over here at 3877. About a 17-point gap up. Okay, so that represents an $800, $850 potential profit if the market were to go directly down to close the gap, which, as you see, it didn't. But what did the market do yesterday? And what can we tell from market action, from price action, and what we can see on our chart? Well, we see that the previous close was down here at 3860. And we see that the open is over here at 3877. And I have my chart set up with the stochastic, and at this point, the stochastic was oversold. And the market immediately made a head fake to the downside. See this shadow underneath this candle? Made a head fake toward closing the gap. And for those of you who jumped on immediately, well, you were sorely disappointed and you were shaken out. Prices tended to trade up until 9:42. And right over here where I have my cursor, you'll see this formation right over here, this reverse hammer. It's almost a shooting star, right? A shooting star would be if the hammer were above the previous candle. There was a gap between the previous candle and the one beneath it. But nevertheless, this is a reverse hammer. And it corresponded, let's go down to my stochastic, to an overbought stochastic. Now, the reverse hammer corresponding to an overbought stochastic with the gap down here gave indication that this might be a good trade, which in turn, it certainly was. From 38.61, prices moved down from 38.99. So we're talking about almost a 40-point trade. But there's more information that I have on my chart, and my subscribers have this information as well. And that's the trading zone. That's where the market is likely to trade for the day. And so my trading zone, and I'm going to make it visible on this chart, you'll see exactly what I'm talking about. Here was my trading zone for yesterday, January 3rd. And I put this on my chart the evening before this market opened. This is an indication that tells me where the market is likely to trade based on what? A guess? No, it's based on arithmetic. Let me make this a 3-minute chart so that you can see it a little more clearly. Okay, so here is the trading zone from yesterday, and this is what I had on my chart together with this horizontal line indicating the previous close. And again, I always use the stochastic and nothing but this is what I have on my chart. At the end of the day, what can I tell about my trading zone? Well, prices, not only did they trade within the trading zone virtually the entire day, but they respected the support level put in at, or I should say calculated at 38.19. So what is the trading zone and why use it? Well, the trading zone gives a bigger picture of the market. I teach 6 trade setups in my trading course, and there are only 6 trade setups that you need to know. But the trade setups are little pictures or slices of time where the market is likely to go in a certain direction based on historical patterns. Certainly flags and pennants are something that you're probably familiar with, where you know that a breakout will be imminent when the flag or a pennant is set up. You don't know the direction, but nevertheless, it's a setup because it's a pattern that has historically been known to repeat. Those are setups that offer short-term trading opportunities. The trading zone gives a bigger picture. It's a bigger picture of where prices may trade. And so the market trade setups are the little picture. The trading zone is a bigger picture. So again, today there's an FOMC at 2 p.m. Be cautious. There's no need to take undue risks because prices can move 80, 100 points in a very short period of time, and you don't want to have the market whipsaw you. So that's it for today. Thanks so much for watching. I'm sorry I was a little long-winded today. Trade safely, use lots of patience, and I'll see you in my next video. Marv Eisen from Timeless Dollar Trading Academy.